He sent me a screenshot. Breakout, clean structure, RSI confirmation, volume spike, classic. Then, silence. 15 minutes later, hit SL, market's rigged. But what if I told you, it's not rigged, it's rehearsed? Welcome to Trading Psychology Stick, where we decode the mental game behind every trade. Quick note, this isn't financial advice, just one trader sharing hard-won insights with another. See, we're taught to look at price like it's reality, like it's the truth. But what if price is just a stage light, a decoy, a distraction? What if everything you've learned was just the front row view of a theater? Lights, music, tension, drama, meant to keep you watching, reacting, buying your next ticket. What if the breakout wasn't a signal, but a scene? What if the stop loss you just hit wasn't random, but scripted, perfectly to include you? Because here's the truth. The market isn't chaos, it's choreography. Every fake out is an act, every new spike is a sound effect, and every time you feel certain is when you're about to get cast as the fool. This isn't about learning more indicators. This is about reading the script behind the price. This video isn't just another trading theory, it's a backstage pass. And once you step behind the curtain, you'll never watch the chart the same again. You're not here to win by luck. You're here to stop playing the wrong role. And the first step, knowing that what looks obvious is often staged. By the end of this video, you'll be able to read the chart like a director, not a desperate extra. And the next time the market sets a trap, you'll smile, because you'll already know the lines. Section 1. The brightest light hides the deepest trap. You ever notice how the moment everything looks perfect is exactly when it goes wrong? That's not irony, that's design. Price breaks out, momentum strong, news supports the move, everyone's on board, and just as you click buy, convinced this time is different, boom, reversal. Stop hunt, you're out. Then it goes your way. Without you, that's not a mistake, that's a scene. Let me show you exactly what I mean. Pull up EURUSD on the H1 chart from last Tuesday's London session. Price had been consolidating between 1.0850 and 1.0880 for 6 hours. Then, at 8 a.m. GMT sharp, massive green candle breaks above resistance. RSI shoots to 72. Volume triples. Twitter lights up, EUR breaking out. But look closer. That resistance at 1.0880, it aligned perfectly with the previous week's high, a classic external liquidity pool. Smart money had been accumulating sell orders there for days, waiting. The breakout? It was engineered to trigger retail buy stops, creating the exact liquidity needed for institutions to offload their positions. 2 candles later, complete reversal. Price drops 80 pips in 15 minutes. Every breakout buyer trapped. Every stop loss hit, the theater emptied, and smart money walked away with the profits. Have you ever been trapped by a perfect setup that reversed immediately? Type trapped in the comments if this sounds painfully familiar. But here's the key. Not every breakout is a trap. The difference, context, volume, and timing. Real breakouts happen with sustained volume, during optimal trading hours, and often after periods of genuine accumulation, not theatrical consolidation. The market's not reacting to your decisions. It's setting the stage for them. The breakout? It wasn't a gateway. It was a spotlight. And the moment you stepped into it, the trap door opened. See, breakout traders are like the audience in a magic show. They cheer when the magician says, "Now, watch closely." But they're never watching the right hand, because the right hand is meant to dazzle. The real move is hidden in the shadows, where the trick actually happens. Here's a practical strategy. The fade the breakout technique. Wait for that explosive breakout everyone's chasing, then watch for the retest. If price returns to the breakout level and shows rejection, weak candles, long wicks, decreasing volume, that's your signal. Enter short with your stop just above the high. Target, the origin of the consolidation. Risk 1% of your account, no more. The worst part about these traps, they work because they feel like you were right. You had the pattern, you had confirmation. But it wasn't your pattern, it was theirs. And you weren't confirming anything, you were fulfilling a role. Here's something most educators won't tell you. That consolidation before the breakout, that's where smart money accumulates. They're not waiting for the breakout, they're creating it. Building pressure like a director builds tension. And when retail finally sees the obvious move, That's their cue to distribute. Quick mental checkpoint. We've discovered that breakouts can be orchestrated liquidity grabs, but context and volume help distinguish traps from genuine moves. Still tracking? The smart money doesn't enter on the breakout. They engineer it. They build the narrative, draw the crowd, and then vanish, leaving you wondering why the lights just went out. And once you realize this, something shifts. You stop reacting to the action. You start reading the motive. You stop chasing certainty, and you start spotting choreography. The next time you see a breakout, pause. Ask yourself, who wants me to believe this? What's the broader context? And what role am I being cast into? Because if you can't answer that, you're probably not the director. And if this just opened your eyes to how theatrical breakouts really are, wait until you see what happens when the whole audience claps at the wrong time. Section 2. When everyone claps, the curtain's about to fall. There's something strange about applause. It always comes just before the scene ends. Remember GameStop in January 2021? When every Reddit trader, Twitter influencer, and your uncle who never traded suddenly agreed, this is going to the moon. The stock hit $483. Euphoria everywhere. And then, down 90% in 2 weeks. The curtain didn't just fall, it crashed. Or take Shiba Inu in October 2021. Crypto Twitter exploded. SHIB to 1 cent was trending. Elon tweeted, exchanges crashed from demand. But check the on-chain data from that week. Large wallet addresses were distributing, not accumulating. While retail bought the dream, smart money sold the reality. Think about the last time you felt completely sure of a trade. Maybe you saw it on social media. A wave of influencers suddenly agreed, this is the breakout we've been waiting for. The volume surged. You felt that little electric jolt of FOMO. You clicked in, and then nothing. Price reversed. You got stopped. And the silence that followed, that was the sound of the curtain dropping. The truth is, when the crowd agrees, the scene is already over. Because markets aren't moved by opinions. They're moved by liquidity. And nothing generates liquidity like mass belief. You weren't part of a trend. You were part of an exit strategy. Comment below, have you ever bought something because everyone else was excited about it? What happened next? Let's get specific. GBP USD, March 15th, New York session. UK inflation data beats expectations. Cable shoots up 120 pips in 10 minutes. Financial Twitter goes wild. GBP moon mission. Retail orders flood in at 1.2450. But here's what the crowd missed. That spike took price directly into the previous month's high at 1.2465, a massive sell-side liquidity pool. Smart money had resting orders there for weeks. The bullish news was just the catalyst to drive price into their distribution zone. Result? Violent rejection. 200 pip drop in 3 hours. Every late buyer liquidated. The news was real, but the move was theater. Here's where it gets interesting. You know what we call those previous highs and lows in smart money concepts? Liquidity pools. Think of them as audience seating charts. Equal highs, that's a sold-out show. Equal lows, standing room only. And smart money, they're not buying tickets, they're collecting them. But remember, consensus isn't always wrong. During strong trends, the crowd can be right for extended periods. The key is distinguishing between early trend consensus and late-stage euphoria. Early consensus happens quietly. Late-stage consensus screams from rooftops. So, why does this keep happening? Because we forget something crucial. If it's visible to everyone, it's priced in. If it feels easy, it's bait. If it feels popular, it's late. The market loves to reward conviction, just long enough for it to become consensus. Then it punishes the crowd for clapping too soon. This is why real traders don't look for confirmation. They look for confusion. They enter where others hesitate, not where others cheer. Because they know. The loudest applause comes right before the lights go out. Here's a practical approach. The consensus fade strategy. When you see overwhelming agreement on social media about a move, wait. Let the first wave of enthusiasm pass. Then watch for exhaustion signs, decreasing volume, weakening momentum, rejection at key levels. That's often where the real opportunity lies, in the opposite direction. Quick reality check. So far, we've seen that breakouts can be staged, and crowd agreement often signals distribution, not accumulation. But context matters. Not all consensus is terminal. Starting to see the nuanced picture? You want to trade like the smart money? Stop looking for agreement. Start looking for conflict. Find the moment when price makes people feel uncertain, not euphoric. That's usually where the truth begins. The market loves this game. It's like a comedian who waits for the audience to lean in before delivering the punchline. Except here, the punchline is your stop loss. So next time you feel the market is finally clear, take a step back. Ask, why does it feel easy now? And who might be exiting while I'm entering? Because applause may feel good, but on Wall Street, when everyone claps, someone's already leaving through the back door. And if you think this was revealing, wait until you realize the market doesn't just fake direction. It also fakes intention. You stare at the chart. The candles push up hard. Displacement, break in structure, FVG below. You hesitate. Is this the real move or another act? Let me show you something that changed how I trade forever. Bitcoin, December 2023, 4-hour chart. Price breaks above 42,000 with authority. Clean market structure shift, bullish order flow. Then it drops back, fills the FVG at 41,200, consolidates for 8 hours. Most traders gave up. Failed breakout, they said. But watch what happened next. Price exploded to 48,000 in 2 days. That wasn't a failed breakout. It was a textbook inducement. The initial spike above 42,000, that was to trap early shorts. The drop to 41,200, that was to shake out weak longs. The consolidation, that was accumulation disguised as indecision. Because once you see the market for what it is, a theater of intention, you stop asking where price is going and start asking why it's going there that way. See, most traders still believe price is truth, that if something breaks structure, it's real. But structure alone doesn't reveal intent. It reveals choreography. A price push isn't confirmation, it's an invitation to misinterpret. Let me introduce you to a concept that changed everything for me: inducement. It's when the market shows you exactly what you want to see, a break of structure, a confirmed trend change, just to pull you in before the real move begins. Think of it as the false climax before the actual plot twist. Here's a real example. Gold on M15 during London session. Price breaks below B1950, taking out the Asian session low. Sellers pile in. But look at the volume. It's decreasing, not increasing. That's your first clue. Then price quickly recovers above 1,950 and consolidates. 2 hours later, massive push to 1,975. That break below 1,950 wasn't a bearish signal. It was inducement to trap sellers and create buy-side liquidity for the real move-up. The smartest money in the world, the ones who don't flinch. They don't just look at the candle. They look at when it appeared, how it moved, what it violated, and most importantly, who just got trapped. Type inducement if you've ever been faked out by a false break that reversed to trap you. Let's see who's experienced this theater. Here's what most don't understand about fair value gaps. They come in flavors: CB, sell-side imbalance, buy-side inefficiency, busy, buy-side imbalance, sell-side inefficiency, and regular FVGs. Each tells a different story about who's in control and what's coming next. But if you're just looking for gaps to fill, you're reading the subtitles while missing the performance. Not every gap gets filled. Not every imbalance matters. Context is king. An FVG created during high-impact news often stays unfilled. An FVG during quiet accumulation usually gets revisited. Learn to read the story, not just the sentences. Because this market isn't about logic. It's about pressure, rhythm, deception. It knows that humans react to tempo, to patterns, to scenes. And if you're reacting to price instead of listening to what it's setting up emotionally, you're acting on cues you weren't meant to see. Time for a breather. We've uncovered 3 acts so far. Breakouts can be traps, but context matters. Consensus often signals exits, but not always. And the market uses inducement to build liquidity. Still with me? Here's the pivot. You must stop trading the surface. Begin sensing the script. A candle isn't a signal. It's a sentence. A displacement isn't an invitation. It's a declaration that something has shifted in the internal narrative. So, what if you began watching the market like a play? Not fixating on what's happening, but on what the scene is trying to evoke. Because real trading isn't about reacting faster. It's about noticing the setup behind the setup, the misdirection, the pacing, the unresolved tension that demands a resolution. And just when you begin to read the market that way, You'll stop seeing breakouts as entries and start recognizing them as monologues, trying to convince you of something that isn't real. Now, if price can fake direction and intention, what else could it disguise? Section 4. The masks of smart money. There's a strange moment that happens right before the market turns. A calm. A kind of silence on the chart. The candles slow down. The volatility fades. Most people think it's indecision, but it's not. It's the actors changing masks backstage. Let me show you exactly what this looks like. Tesla stock. September 2023. Daily chart. After a strong rally to 280, price enters a tight range between 275 and 285. Volume dries up. Retail traders get bored. Dead stock, they say. Forums go quiet. But underneath, check the dark pool data. Massive accumulation happening. Block trades in the millions. Smart money wasn't being indecisive. They were loading up while wearing the mask of weakness. 3 weeks later, Tesla breaks out to 340. Those who waited through the boring phase caught a 20% move. Because smart money doesn't just move the market. It disguises itself within it. It doesn't wear a name tag that says, "I'm accumulating now." It plays roles. It appears weak when it's about to act strong. It sells to trigger panic, just to buy it all back in silence. That's why most traders enter right after the smart money exits. They're watching the mask, not the eyes underneath. Let's dive deeper into these masks with real examples. The accumulation mask. Wyckoff called it right, but here's how it looks today. Apple before earnings, October 2023. Price struggles at 175. Bearish news everywhere about iPhone sales. Retail sentiment turns negative. But look at the order flow. Massive call options being bought. Dark pool prints showing accumulation. The weakness was theater. Post-earnings, gap up to 190. The distribution mask, even more deceptive. Nvidia at 500 in February 2024. Every dip bought aggressively. Retail euphoric. Going to 1,000, they scream. But check the insider sales. Massive. Check the call-put ratio, shifting bearish. The strength was distribution in disguise. 2 weeks later, down to 420. And those multiple types of order blocks, let me show you. Bullish order block. The last down candle before a strong move up. But here's the key. It needs to take liquidity below it first. EURUSD, Asian session low gets swept, then massive push-up. That sweep wasn't failure. It was fuel gathering. Breaker block. When a bullish OB fails and becomes bearish. Gold breaks above 2,000, pulls back to 1990 OB, then fails and drops to 1950. The OB transformed, changed masks from support to resistance. Mitigation block, where price returns to apologize for an aggressive move. Bitcoin spikes from 40K to 43K, leaving an FVG. Returns to 41.5K to mitigate, then continues up. It's like checking if anyone noticed the costume change. Quick exercise, look at your last losing trade. Can you spot where smart money might have been wearing a different mask than what price showed? Here's a professional secret. Volume profile shows you where the audience sits. Value area, high, value area low, point of control. These aren't just levels. They're the theater's seating chart. And when price approaches these areas, it's not random. It's calculated, like an actor knowing exactly where the spotlight will hit. US 30 at the point of control from the previous week. Price struggles, retail thinks it's resistance. But smart money, they're absorbing every sell order. Once retail capitulates, boom, straight through. The resistance was just smart money's buying zone in disguise. Remember, not every quiet period is accumulation. Not every rally is distribution. You need confluence, multiple factors aligning, volume patterns, option flow, time of day, larger time frame context. The amateur waits for confirmation. The experienced trader waits for misdirection. Because that's where smart money lives, not in the clarity, but in the confusion right before the turn. So next time you see price hesitate, get quiet. Ask yourself, is this uncertainty or is this the mask changing? Because when you can answer that, you're not watching the play anymore. You're finally reading the script. But the most critical part of the story, it isn't the actor, it's the timing of the performance. And once you understand when the scene is set to change, everything else fades away. Section 5. Time is the stage. not the background. Price doesn't move in a vacuum, it moves on schedule. But most traders miss that because they think time is just background, something that ticks while you wait. But what if time wasn't passive? What if time was the stage itself? Let me prove it to you with data. Study any major currency pair for a month. Mark every significant move. You'll find 70% happen during 3 windows: London Open, 3:05 a.m. EST, New York Open, 8:10 a.m. EST, and London Close, 11 a.m. 1 p.m. EST. The other 21 hours, mostly noise. A liquidity sweep at 3 a.m. is just noise. The same sweep at 8:30 a.m., right when London overlaps with New York, is intention, precision, setup. Here's a specific example that cost me $5,000 to learn. AUD USD, perfect setup at 11 p.m. EST. Displacement, MSS, FVG, everything aligned. I entered, spent 4 hours watching it chop. Stopped out. The exact same setup appeared at 3 a.m. London Open. Explosive move, 100 pips in my original direction. The setup wasn't wrong, the timing was. You see, smart money doesn't act randomly, it acts rhythmically. It uses killzones, windows of time where volume surges and emotions spike, to execute the play. But here's what most don't understand about these time windows. It's not just about London Open or New York Open, it's about the power of 3. Accumulation, manipulation, distribution. And these 3 acts happen in specific time sequences. Asian session, 7 p.m., 3 a.m. EST. Accumulation, the stage is set quietly, range-bound price action, smart money positions itself. London session, 3 a.m., 11 a.m. EST. Manipulation, the trap is sprung, false breakouts, stop hunts, inducement, maximum emotional damage. New York session, 8 a.m., 5 p.m. EST. Distribution, the real move unfolds. Trending price action, smart money offloads to retail. This is called the AMD cycle, and once you see it, you can't unsee it. Here's a tradable example. GBP, JPY, watch it for a week. Asian session creates a range. London opens, immediately spikes above the range, manipulation, then reverses hard and trends down through New York, distribution. Like clockwork. The script rarely changes, only the actors. Comment AMD if you've noticed this pattern, but didn't have a name for it until now. Here's something wild. The interbank price delivery algorithm, IPDA, runs on a schedule. Every 20-day cycle, every 40-day cycle, every quarterly shift. The market breathes in predictable rhythms, but most retail traders are holding their breath at the wrong moments. Time is what separates noise from signal. You might see the same price action 3 times in a day, but only one of them matters, the one that hits right at the market's emotional crescendo. That's when orders flow. That's when roles switch. That's when the script flips. Pop quiz: how many times have you taken a perfect setup in Asian session only to get chopped up? That's not the setup failing. That's you auditioning during rehearsal hours. The consolidation breakout strategy, time-based. Wait for Asian session consolidation. Mark the range, set alerts. When London opens, wait 30 minutes for the manipulation move, false break. Then position yourself for the real move in the opposite direction. Stop loss beyond the manipulation spike. Target, 2x the Asian range. This works because you're trading the script, not the price. Most retail traders fail not because their strategy is wrong, but because they entered during the intermission. They acted in the quiet, expecting drama, but the curtains hadn't even opened yet. So here's the shift. Stop treating time as a container. Start treating it as a signal. Track the open, track the overlap, track the volume surge. These aren't just moments. They're cues, like stage lighting, like a change in music. They tell you, something's about to begin. Let's pause again. We now understand that breakouts need context. Crowds signal exits with nuance. The market uses inducement, smart money wears masks, and time itself is the stage. Feel that paradigm shifting? But timing only gets you so far. Because even when you arrive at the right moment, you still need to know which direction the story wants to go next. And that's where the final twist comes in. Section 6. The final act begins when the crowd exits. There's a moment in every great story when the theater thins out. People check their phones. A few leave early. The energy dips. And then, boom, the twist drops. The entire plot turns. The real meaning is revealed. And those who left, they never saw it coming. Markets work the same way. Real example, crude oil, March 2024. Perfect bullish setup at 78.50. Displacement up, retraced to FVG, sitting at key support. I enter. Nothing happens. An hour passes. Chop. 2 hours. Still nothing. Twitter goes quiet. Oil is dead, someone posts. I'm frustrated. Close my position for a small loss. 20 minutes later, massive news hits about OPEC cuts. Oil rockets to 82.0. My exact setup, my exact direction. But I wasn't there for the final act. That wasn't bad luck. That was the final act. And I missed it. Not because I was wrong, but because I was impatient. Here's what actually happened in that dead period. Smart money was testing. Each small push-up, checking for sellers. Each minor dip, absorbing any remaining supply. This is called clearing the path, and it's as methodical as a stage crew adjusting lights before the grand finale. Volume profile confirmed it later. Massive accumulation in that boring consolidation zone. Point of control building right at my entry. Smart money was loading up while I was checking my phone. This is the secret few will ever tell you. Smart money uses time not just to trap, but to exhaust. They know most retail traders don't have the endurance to wait, so they bait the early move, then stall, drain your energy, erase your confidence, and when you finally give up, that's when they begin. Type patience if you've ever missed a perfect move because you gave up during consolidation. Let's see how many of us have been in this same theater. This is called time-based manipulation. The idea that intention isn't always expressed in speed, but in delayed motion. A pause that invites doubt. A stall that creates false neutrality. Want to know something that will change how you see consolidation forever? Those sideways candles aren't indecision, they're precision. Each one is a small test, a micro-manipulation, building pressure like a spring. And springs don't bounce when you watch them. They bounce when you look away. Here's a strategy for the patient. The exhaustion breakout method. After a clear displacement, price retraces and consolidates for more than an hour. Most traders leave. That's your cue to stay. Set a tight stop below the consolidation. When price finally moves, it often moves violently in the original direction. The longer the consolidation, the stronger the move. But, and this is crucial, not every consolidation leads to continuation. If price consolidates for too long, over 4 hours in a kill zone, or if it happens during off hours, the probability drops. Context, as always, is king. You begin to recognize that the real setups don't feel exciting. They feel quiet. They don't scream entry. They whisper, wait. This is where concepts like mitigation come in. After that violent move, price often returns to mitigate, to test if anyone's still believing the old story. When no one reacts, that's when the real story continues. It's like checking if the audience is still paying attention before revealing the plot twist. So the next time price slows down after a clear displacement, don't assume the story is over. Zoom out, breathe, ask, is this the end of the show or just the calm before the curtain rises again? Because patience isn't just a trait, it's an edge. And the longer you can sit in silence, the clearer the stage becomes. But even when you get the direction right and the timing perfect, there's still one more trap left. The most dangerous one, the one that doesn't come from price, but from inside you. Section 7. The enemy isn't the market, it's your script. You've read every PDF, watched every smart money video, drew every order block, timed every kill zone, and yet, somehow, the results don't match the knowledge. It's not that the market fooled you, it's that you kept reciting an old script, one that was never yours to begin with. Let me be brutally honest. January 2023, I had 10K in my account. Understood every concept we've discussed, could spot inducement in my sleep. By March, I had 3K left. Not because I didn't know, because I couldn't stop myself from knowing. Every loss triggered the same response, double the position size. Not because the setup was better, because my ego was bleeding. I wasn't trading EURUSD. I was trading my need to prove I wasn't a failure. One trade stands out. Gold, perfect setup at London Open. Price swept Asian lows, returned to FVG, showed rejection. Textbook. I enter with proper risk. It goes against me 20 pips. Instead of waiting for my stop, I add to the position. It has to turn here, I tell myself. It drops more, I add again. Now I'm risking 5% instead of 1%. You know how this ends. Stopped out for a massive loss. The worst part? Price eventually went my direction. My analysis was perfect. My psychology was broken. Because even when we learn advanced concepts, we carry with us the emotional blueprint of our past. The need to be right, the fear of missing out, the urge to prove we finally figured it out. But trading doesn't just test your strategy, it tests your identity. And most of us don't realize. We're trading to protect a version of ourselves we haven't let go of yet. You don't trade price, you trade your narrative about price. And if that narrative is rooted in proving, forcing, chasing, no concept will save you. This is called revenge trading, but it goes deeper than revenge. It's identity protection. The market becomes a mirror, and every loss feels like a crack in the image you're trying to maintain. Here's the risk management truth no one talks about. Position sizing isn't just about protecting capital, it's about protecting sanity. Every time you risk more than you can emotionally afford to lose, you're not trading. You're gambling with your identity. My rules now: 1% risk per trade, no exceptions. 20 trades in a row can go wrong, and I'm still down only 20%. More importantly, I can still think clearly. My ego can't hijack my decisions when the stakes stay manageable. So here's the uncomfortable mirror. Have you ever placed a trade just to feel worthy? To feel like you're improving? To feel like you belong in the real trader club? What if the biggest upgrade isn't your chart, but your inner monologue? Real talk. Who here has ever increased position size, not because the setup was better, but because you needed to make it back? Drop a guilty in the comments. No judgment. We've all been there. Because once you stop needing the market to validate you, you start seeing it clearly. You become calm when others are impulsive. You become still when others chase. You become selective when others overreact. This is the difference between FOMO, fear of missing out, and JOMO, joy of missing out. JOMO is when you smile watching a movie you didn't take, because you know your setup hasn't appeared yet. It's freedom from the script that says you must catch every move. The mental exercise that changed everything for me. Before each trade, I ask, am I trading the chart or my emotions? If I feel any urgency, any need to be right, any desire to prove something, I don't trade. The market will be there tomorrow. My mental capital might not be. Quick check-in. We've revealed that markets use theatrical tricks, but discipline and proper context help navigate them. Your psychology might be the biggest factor. How's that sitting with you? That's when you stop watching the play. That's when you stop acting. That's when you become the one writing the script. And there's only one thing left to do now. Tie it all together. Not just in theory, but in transformation. Section 8. Your first role, the observer. So, you understand the theater. You see the traps. You recognize the masks. But understanding and executing are different stages. How do you actually trade this way? First, you accept a new role. Not the hero, not the victim, the observer. Tomorrow, when you open your charts, don't look for trades. Look for scenes. Watch one full session, London or New York, like you're watching a play. No positions, just observation. Here's your observer's checklist. Where are the equal highs and lows? Those are your liquidity pools, the audience waiting to react. Mark them. Watch how price behaves around them. When does price move fast versus slow? That's the rhythm, the difference between dialogue and action sequences. Fast moves often trap. Slow moves often build. Which moves get retraced immediately? Those are the inducements, the false climaxes. Make note of where they happen and what follows. Where does price return to after big moves? Those are the mitigation blocks, the script checking if anyone remembers the last act. Real exercise I do daily. 1 pair, 1 session, 0 trades. I take screenshots every hour. End of session, I review. Where was smart money accumulating? Where did they distribute? What masks did they wear? After a week, patterns emerge that no indicator could show you. This is how you develop what I call market empathy, the ability to feel what the market is trying to accomplish, not just see what it's doing. Here's a practical exercise. Pick EURUSD. Set 4 alarms: Asian Open, London Open, New York Open, London Close. At each alarm, write down, what role is the market playing right now? Accumulation, manipulation, distribution. After 1 week, you'll see the AMD cycle clear as day. The intermediate step, paper trade with theatrical awareness. When you see a setup, ask, what act is this? Who's already trapped? What would smart money want to happen next? Where are the actors changing masks? Enter only when you can answer all four. Your risk management becomes different too. Instead of risking 1%, you're paying for a theater ticket. Some shows cost more than others. A London Open setup might be worth a full ticket. An Asian session crawl, maybe just standing room. Position sizing example, $10,000 account. 1% risk equals $100. EURUSD setup with 20 pip stop loss. That's $5 per pip, or 0.5 lots. Simple math, powerful psychology. You can be wrong 10 times and still have $99,000. That's freedom to observe without panic. Want to really level up? Start journaling trades like movie reviews. Today's EURUSD performance featured a convincing accumulation in Act 1, followed by a predictable manipulation spike that trapped eager retail buyers. The distribution phase was textbook, complete with mitigation block encore. Rating, 4 out of 5 stars. Would trade again. Comment below, ready to observe if you're willing to spend one session just watching, not trading. Let's see who's serious about transformation. Remember, every great director started by watching. Every successful trader began by observing. The market will always be there tomorrow. But will you see it differently? The transition from reactor to observer isn't just a strategy shift. It's an identity evolution, and it starts with one session of pure attention. Now for the final scene, the one that brings our entire story full circle. Final scene, step off the stage, pick up the script. You came in thinking price was your enemy, that smart money was this invisible villain, that you just needed the right tool, the perfect setup, to beat the market. But now, you know better. You've seen that the market isn't chaos, it's theater. And every trap, every fake out, every too good to be true move was written in advance. You learned that breakouts can be scenes, but context and volume reveal the truth. That when the crowd claps, the curtain might be falling, but strong trends exist too. That time isn't background, it's the spotlight that illuminates real opportunities. That fair value gaps, order blocks, and displacements aren't magic. They're footprints in the script that need proper context. That smart money wears masks of accumulation and distribution, but confluence helps you see through them. That patience pays better than prediction when applied with discipline. And most of all, you realize the biggest trap isn't out there. It's in here, in the voice that needs to win, to prove, to rush, to become something. But here's the final truth. Not every move is manipulation. Not every consolidation is accumulation. The market isn't always out to get you. Sometimes it's just seeking fair value. Sometimes trends are real. Sometimes breakouts lead to more breakouts. The skill isn't in seeing conspiracy everywhere. It's in distinguishing performance from reality, theater from truth. And that comes from observation, practice, and most importantly, emotional control. So, what now? Now you pause. Now you observe. Now you trade the story behind the story when the story is actually there. Because here's the truth. Real traders don't predict. They interpret. They don't react. They decode. They know when to act, and more importantly, when to wait. Not with paranoia, but with clarity. Not with ego, but with discipline. Remember, risk management isn't optional. Psychology isn't secondary. And patience isn't just waiting. It's waiting for the right moment with the right mindset and the right position size. If this message hit you, not just intellectually, but emotionally, then you're part of something rare. A trader not looking for shortcuts, but for sustainable edge. Comment below, I've stepped off the stage, so others know they're not alone. Subscribe if you're done memorizing setups and ready to start understanding context. Share this with the trader who's always almost there, but never quite sees the full picture. Join our community where we decode not just charts, but the psychology that moves them. Because the best traders aren't just technically proficient, they're emotionally intelligent and properly capitalized. The market doesn't reward those who act first. It rewards those who act wisely. Those who see patterns but verify with confluence. Those who understand the game but play it with discipline. Welcome to the other side of the stage. The view is clearer here, more nuanced, more profitable. And once you see it, you never go back. The play continues tomorrow. Will you be reacting to the script or finally writing your own?